It is December 2005. A broker at Mizuho Securities in Japan receives an order to sell one share of a newly listed company called JCOM for 610,000 yen. But in a rush, he types the numbers backward. Without realizing it, he presses enter to sell 610,000 shares for just 1 yen each. The moment the trade goes live, the market panics. Millions of shares flood the exchange at a fraction of a penny. The stock's value plummets instantly. Across the trading floors, professional money managers freeze. They assume a massive financial fraud is unfolding and refuse to touch the stock. But miles away from those frantic trading desks, a guy in his 20s eating cup ramen in a tiny apartment sees the exact same drop. Going by the online handle BNF, he calmly looks at the plunging numbers, realizes someone made a massive clerical error, and starts buying. Within minutes, he scoops up a 49% stake in the entire company. Back at Mizuho Securities, the executives realize they cannot reverse the trade. They desperately try to buy back their own shares. Other traders, terrified by the chaos, cash out whatever they can. BNF simply turns off his computer and holds his shares overnight. The next morning, the government steps in and halts trading. They refuse to cancel the broker's error. With no other options, Mizuho agrees to settle with the buyers at a massive premium. BNF's payout for that single quiet trade is $20 million. He didn't work for a bank, he didn't have inside information, and he certainly didn't have a team of analysts. He won because he understood exactly how professional traders react when they are terrified. To understand how he developed that instinct, we have to look at his college years. BNF was broke, working night shifts and weekends just to save up $16,000. Around that time, he watched a TV documentary about a legendary speculator named Victor Niederhofer. The idea of making a living entirely through your own independent decisions hooked him. But he was walking into a terrible economic climate. Japan was suffering through what economists call the lost decade. It was a multi-year bear market where overall asset prices had crashed by 70%. BNF figured out exactly when that band was stretched to its limit. Through careful observation, he noticed that when a stock's price deviates at least 20% below its moving average, the fear is completely exhausted. The tension is completely maximized. That is exactly the moment when he buys. Because you can't stretch a rubber band forever. Eventually, the panic subsides, and the price violently snaps right back up towards its normal average. By buying at maximum tension, he captures the profit on the way back up. He spent zero time analyzing a company's product line or reading their quarterly earnings reports. He treated the market as physics, buying the exact moments of maximum human overreaction. But there was a catch. Not every stock behaves like the same kind of rubber band. Some are thick and rigid, while others are thin and highly elastic. BNF realized that his 20% rule wasn't a magic number for the entire market. If a service sector stock dropped, it was rigid. It would hit maximum tension and snap back after just a 22% drop. But tech stocks were highly volatile. They could stretch all the way down to a 45% drop before finally snapping back. Figuring out the specific breaking point for every single industry took brutal repetition. BNF locked himself in his apartment, turned off the news, and spent 2 full years studying the numbers day and night to map these percentages. By mapping specific breaking points of every industry, BNF turned observation into a mechanical advantage. He no longer had to guess where the bottom was. He had already measured it. By the year 2008, Wall Street was starting to crack. The U.S. banking system was showing deep signs of distress. Looking across the globe, BNF noticed the massive investment bank Lehman Brothers taking a heavy hit. He checked his numbers. The stock had dropped perfectly into his target zones for a snapback. Trusting his math, he took $6.5 million of his own money and bought in. But the band didn't snap back. The bank was collapsing under the weight of toxic mortgage debt. Instead of rebounding, the rubber band snapped. Lehman filed for bankruptcy, and his $6.5 million disappeared overnight. The math of human panic only works if the machine itself is still functional. He realized he traded entirely outside his expertise, playing in a market he didn't fully understand. The collapse of Lehman Brothers sent a shockwave across the globe. As international trade froze up, the Japanese market took a heavy hit, and the country's primary stock index plummeted. The sheer velocity of the crash tore right through BNF's carefully mapped targets. The rebounds he usually relied on were failing, and his initial trades were piling up, compounding losses. Instead of freezing, he went to work. While news networks broadcasted endless panic, he sat quietly in his room, watched how the new drops behaved, and recalculated the breaking points for every single sector in real time. Then he made his move. While institutional investors were desperately liquidating their portfolios, BNF bought into 90 different companies across the Japanese index. He put $65 million on the line. He was staring at the worst financial collapse in a generation, and he chose to bet his entire accumulated fortune that his revised math was right. The very next morning, the market opened green. The intense selling pressure had finally exhausted itself, and across the board, the rubber bands snapped back. He began unloading his positions and walked away with a $12 million profit. That trade cemented his status in Japan. Financial magazines wrote about him, and even billionaire investors like Masayoshi-san wanted to meet with him. But BNF had no interest in high society parties or living out of luxury hotels. He used some of his profits to buy commercial real estate, securing a safe, long-term return on his cash. But day to day, nothing changed. He went right back to his small apartment, ate a ramen, and kept looking at the charts. He proved that beating the market doesn't require a pedigree or insider connections. It requires the patience to sit quietly, the discipline to map the mechanics of human fear, and the courage to act when everyone else is running for the exit.